Hey, good evening, everyone. Good evening, dear students.
Recording in progress.
How are you all? Shriji, Akkam, all good? Well, good. Okay, so today our topic for revision is cost of capital. So, topic for revision today is cost of capital. Now, cost of capital, it is basically the expected, or instead of expected, we can say this is representing the required rate of return is the required rate of return on or required rate of return by the capital providers. By the capital provider. Okay. So required rate of return by the capital provider. Now, how many sort of capital providers are we discussing over here? We're discussing capital providers as one part is going to be debt, another is preference shares, and third is equity. Debt, preference shares, and equity. Okay. So let us first talk of how do we calculate the cost of debt. What's the formula for cost of debt, guys? Formula for cost of debt. So it depends whether it is a redeemable or it's a irredeemable. So cost of debt is going to be interest into 1 minus T upon net proceeds. If it is irredeemable, and this is going to be interest into 1 minus T plus redemption value minus net proceeds divided by N. The whole thing is divided by redemption value plus net proceeds divided by 2. So interest into 1 minus T plus RV minus NP the whole by N, the whole divided by RV plus NP by 2. This is the formula in case of redeemable debt. Right? Then next is cost of preference shares. Preference dividend upon net proceeds. This is in case of irredeemable debt. And this is going to be preference dividend plus redemption value minus net proceeds by N, the whole divided by redemption value plus net proceeds by 2. Okay, so this is in case of redeemable preference shares. This is going to be in case of redeemable preference share. Okay, so that's cost of debt, cost of preference share. Then, how do we calculate the cost of equity, guys? Cost of equity is computed as there are multiple models. It could be like dividend per share upon market price per share, or you can even calculate it as earnings per share upon market price per share, or it could be D1 upon current market price plus G, or capital asset pricing model. It's going to be RF plus beta into RM minus RF. So KE is DPS upon NPS, or it's going to be EPS upon NPS, or it's going to be D1 upon P0 plus G, or RF plus beta into RM minus RF. Okay, that's your cost of equity. Then, How do we calculate the weighted average cost of capital? So for weighted average cost of capital, we simply write down the capital amount. And remember, this amount can be market value or it can be even book value. Then you calculate the weights. Okay, capital, amount, and then weights, and then cost. Then this is going to be weights into cost. Okay, and then when we take a total of it, that's going to be the weighted average cost of capital or KO. Okay, so these are the concepts broadly which we have in cost of capital. Right, so cost of capital, we have cost of debt, cost of preference share, and cost of equity, right? And then we have to calculate the weighted average cost of capital in this particular manner, right? Are we able to recall these things, everyone? Are we able to recall these things? Yes, guys. So how shall we take it ahead? Shall we start with the questions now? And would you like to solve it? Or you want me to solve it directly? So let us say I'm taking up certain questions on cost of capital. Let's say look, let's take up this one. We have to calculate the weighted average cost of capital. And this is the information that we have. The company's present book value capital structure. It has got debentures of 8 lakh, preference shares of 2 lakh, equity shares of 10 lakh, totaling to 20 lakhs. All these securities are traded in the capital market. Recent prices are debentures 110 per debenture, preference share is 120 per share, and equity shares is 22 per share. These are the ongoing prices. External financing opportunities are given to us. 100 per debenture redeemable at par, 10-year maturity. 11% is the coupon rate. 4% is the flotation cost. Sale price is 100. So from this, we can get the cost of debt. From this information, we can get the cost of preference share. And from this information, we can get the cost of equity. In addition, dividend expected on equity share at the end of the year is said to be 2. Anticipated growth rate is 7%. And the firm has a practice of paying all its earnings in the form of dividend. The corporate tax rate is 35%. Okay, the corporate tax rate is 35%, and these numbers are given. We have to calculate the weighted average cost of capital. So, would you like to solve it? Would you like it solve it first, guys? Yeah? Tell me, guys. Would you like to solve it first, and then we'll discuss it, or you want me to solve it directly? Yes. Shagufta, Abhishek, Shriji, Akkam, Kavya, Naina. Will you solve this, or you want me to solve directly? Hello, everyone. Want to solve it? Yes, Akkam.
Sir, actually, we are sending messages. We're not sure which one we have to send it to. There are
Okay,
like
I think one second. I'll just see if I can. Are you sending over here? Acha.
yes.
Okay. So I've joined from two devices, so probably that's the issue. So the device, with the initial S, just message on that. The DP which has got S, right? So message on that. Okay, I got it. Yes, I want to solve. Okay, you want to solve it? Okay, fine. Then for this, let's do it step by step, one by one, right? We'll just verify one by one yeah, every number, and then we'll proceed. So first, you have to give me the cost of debt, then cost of preference share, and then cost of equity, and then we'll go for the weighted average cost of capital. Okay, sure, guys. So try to solve it. I've renamed it, so henceforth just message on CA Jagbandu, the participant. How much is the cost of debt, guys? Cost of debt, it's going to be interest first. So interest is going to be coupon rate is 11%. So 11 into 1 minus tax rate. Tax rate is 0.35. Plus the redemption value is 100 itself, and even the sale price is going to be 96 because there's a flotation cost given to us, right? So I need to subtract the flotation cost. So plus 100 minus 96 divided by 10-year maturity. And then this entire thing is going to be 100 plus 96 divided by 2. So how much is cost of debt, guys, with this formula? With these numbers, how much is the cost of debt? 11 into 0.35. So 11 into 0.65, 7.15 plus 0.4. This divided by 98. So it is 7.70%, everyone. Is everyone getting 7.70% KD cost of debt, everyone? Yeah. Cost of debt 7.7. Then try out cost of preference share, and also cost of equity. Give me both the answers. Yes, Akam.
So just a small doubt. We can also do KD by taking the current price, right? Like the recent price, which is 110.
Recent price means you're talking of 110.
Yes, sir.
No, that's for calculating the market value. Beta. So say when the question is giving you external financing opportunity, there's a sale price 100 and flotation cost given. So I have to take these values.
Okay.
That 110 is for calculating back using the market values.
Oh, okay, sir.
Okay.
Thank you, sir.
Get the cost of preferential and cost of equity also, guys. Cost of preference shares, that's going to be dividend rate is 12. So there's no tax effect over here, but plus it's going to be 100 minus 95 by 10, the whole divided by 100 plus 95 by 2. How much is this? Cost of preference share. Is it 12.82? So it is 5 divided by 10. 0.5 plus 12. 12.5 divided by 97.5. 12.82. That's 12.82%. Perfect, guys. What about KE? Cost of equity. We have dividend at the end of the year. It's given 2. So D1 upon P0. But the flotation cost is given. So 2 divided by 20. Plus we have a growth rate in dividend of 0.07. So cost of equity is 17%. Right, guys? Okay, fine. Now you can just go ahead and calculate the weighted average cost of capital using book values and also the market values. Calculate it, guys. Yeah, Srini. Sale price is 22, but then there is a flotation cost also given, right? Flotation cost of 2 is given, so we need to subtract that. Okay. Okay. So book value based, it's got it. Okay, fine. So we have got capital, book value, weights, costs, and then weights into cost. So capital is debenture, preference share, equity, debenture, preference share, equity. So book values are directly given to us 8 lakh, 2 lakh, and 10 lakh. So total is 20 lakhs. Weights are 0.4, 0.1, 0.5. And what are the costs? Debentures is 7.70. Preference share is 12.82. Cost of equity is 7%. So there we have this as 7.7 into 0.4. 3.08. Then 0.1 into 12.82. 1.282. And then 17 into 0.5, which is 8.5. So let us add all of them. 3.08 plus 1.282 plus 8.5. 12.86. 12.86 when it is book value based. Then same thing, if we do it for a market value based thing, same calculation. If you're going to do for market value based, you have to get the market value. Market value of debentures. For that, we have debentures being trading at 110. So this will be 8,80,000. Preference shares are trading at 120. So this will be 2,40,000. And equity is trading at 22. So this is going to be 22 lakhs. Okay. Then we have to get the weights, cost, and then weights into cost. Let us take a total of it. 8,80,000 plus 2,40,000 plus 22 lakhs. 33,20,000. 8,80,000 divided by 33,20,000, which is 0.2651. Then it is 2,40,000 divided by 33,20,000, which is 0.0723. And 22 lakhs divided by 33,20,000, which is 0.6627. What is the cost? 7.7%, 12.82%, and 17%. And then we do the weights into cost total. So 0.2651 into 7.7, which is 2.04127. Then 0.0723 into 12.82, which is 0.9269. And then 17 into 0.6627. This is 11.2659. And when we add all of them, 2.04127 plus 0.9269 plus 11.2659. 13.3261. That's your KO. 13.3261. Are we getting some different numbers? How come? Where are we going wrong? Yes, Abhishek. Where have we gone wrong? Addition. Totally is wrong. 2.04127 plus 0.9269 plus 11.2659. Oh, it's 14.23. Perfect. Yeah. 14.23. Correct. Yes. So that's our overall cost of capital. So were we able to get it, everyone? Total cost of capital 14.23. Okay, fine. Let's take another question for the cost of capital. Okay, try out this question, guys. Again, we have to compute the weighted average cost of capital. Clearly, it is stated that we have to compute it using market value weights. Will you be solving it? Same information, sort of information is given, and we have to calculate the weighted average cost of capital using market value weights. Will you solve it, everyone? Want to try? Perfect. So let me just set a timer for this then, guys. I'm not going to interfere in between, but I want you to solve it. So it's a 12 marker, approximately, sorry, 6 marker, approximately you should be taking 12 minutes for this. Try it, guys. Give it a try, guys. Let me do the calculations quickly, guys. So we have to calculate the WACC using market value weights. Equity shares 15 lakh 10 per equity share. Reserves and surplus is 5 lakh. Preference share is 7 lakh 50. Debentures is 5 lakh 50. Market price of these securities are debentures 105 per debenture. Preference share is 115 per preference share, and equity share is 27 per equity share. So first we have to get the cost of debt. So guys, cost of debt. For that we have a 10% coupon rate. So 10 into tax rate is 25%. So 1 minus 0.25 plus redemption value will be the face value itself 100 minus flotation cost is 96. 100 minus 96 upon 10, and then the whole thing is divided by 100 plus 96 by 2. So how much is the cost of debt, guys? How much is cost of debt, guys? What's this number? Cost of debt. It's 7.5. 7.5 plus 0.4, 7.9 divided by 98. 8.06%, right? 10 into 100 minus 10% coupon rate, 10-year maturity, 4% is the flotation cost, and sale price is anything given about what's the sale price? No, but market price of the share is given, market price of debenture, which is 105. So market price is given as 105. So I need to take that into consideration, guys. Just hold on. So redemption value is 100 minus. Net proceeds will be 105 minus 4%. Okay, 105 minus 4%. So 105 into 96%, which is 100.8 divided by 10. Because here we have the market price of debenture as 105, right? And 100 being the face value. Redeemable at a premium. Redeemable at a premium. So it is 110. Redeemable at a premium of 10%, 10% coupon rate, and this is okay. So 110 plus 100.8 divided by 2. So that is 110 minus 100.8, 9.2 divided by 10, which is 0.92 plus 7.5. This is 8.42. Okay, so that's 8.42 divided by 110 plus 100.8. This divided by 2, which is 105.4. So 8.42 divided by 105.4. 8.42 divided by 105.4, which is 7.99%. Yes. Did we get it? So here they have not specified what is the sale value in this question, right? They have not specified what is the sale value. So I can definitely take that the sale value is the current market price. And then we get the cost of debt as 7.99. Yes, Ashwin.
So the same thing, sir, just now explained, right? The sale value.
Sale value is given.
So
if the sale value would have been given, we have taken that. But since there is no sale value.
So, sir, we have the issue price, right? Which is 100 rupees in the particulars box. So, what's the difference between this issue price?
Where is
so,
the
sir, I mean, so in the question, the particulars box is there, right? In their debentures, it says 100 per debenture.
That's the face value, beta.
So that's not the issue price?
Nah, that's not the issue price. If they specifically they would have told that this is the issue price, then I would have taken that. But it is just the face value.
So in the sums in general, if there is issue price, we have to consider that. If the question is silent about issue price or sale price,
yes,
then we have to consider market price.
Market price, yes.
So sale price and issue price is same, right, sir? So there is no
sale price and issue price is one and the same. Yeah.
Okay. Thank you, sir. Thank you for clarification.
Okay, so I think you might have got the cost of preference share also incorrect, guys. Cost of preference share, 12%. So 12 into, there's no tax benefit, plus redeemable at par, so 100 minus preference share is trading at 115. Preference share is trading at 115. On that, we have a 2% flotation cost. So 115 into 98%, which is 112.7 divided by 10 years to maturity, and this is 100 plus 112.7 divided by 2. What's the value? Cost of preference share. What's the cost of preference share is? Well, 100 minus 112.7. That's minus 12.7 divided by 10, which is minus 1.27. So 12 minus 1.27 divided by 100 plus 112.7 divided by 2, which is 106.35. Okay, how much is this? Cost of preference shares, it's 10.09%, guys. Yeah. 10.09% is the cost of preference share. Cost of preference share is 10.09%. Then cost of equity. Cost of equity. Now, equity shares are having a flotation cost of 4.5. Market price is 27. So, last dividend that was paid is 2, which is expected to grow at 9%. So, 2 into 1.09 divided by market price is 27, but we have a flotation cost of 4.5 also, plus 0.09. 2 into 1.09, which is 2.18, divided by 27 minus 4.5, 22.5 plus 0.09. So 2.18 divided by 22.5 plus 0.09. So cost of equity is 18.69%. Okay. So we got the cost of debt, cost of preference share, and then cost of equity. And then finally, we have to get the market price. Weighted average cost of capital using market value weights. So weighted average cost of capital using market value weights. Weighted average cost of capital using market value weights, guys. So we have the capital, book value, then we'll convert to market value, then weights, then cost, and then weights into cost. So capital we have equity, reserves, preference share, and debentures. So we have equity, reserves, preferential capital, and debentures. So book values are 15 lakh, 5 lakhs, 7.5 lakhs, and 5.5 lakhs. So 7.5 lakhs and 5.5 lakhs. So this totals to 15 plus 5 plus 7.5 plus 5.5. Total is 33 lakh. Now let's get the market values. So market values are given. Debentures are 105 and equity shares are 27. So it's going to be 15 lakhs into face value over here. It is 10. So I'll just multiply it by 2.7. So that's 40 lakh 50,000 market value. 40 lakh 50,000. Reserves will have no market value because their market value is included in the equity market value itself. Preference share redeemable at par 12% market value is 115. So 7,50,000 divided by 100 into 115, which is 8,62,500. 5,50,000 divided by again 100 into the market price of debentures is 105. So that's 5,77,500. Okay. Debt 5 lakh, 8 lakh 62. Okay. Then the total value is 40 lakh 50,000 plus 8 lakh 62,500 plus 5 lakh 77,500, which is 54 lakh 90,000. So we can get the weights. 40 lakh 50,000 divided by 54 lakh 90,000, which is what, 0.7377. 8 lakh 60,500 divided by 8 lakh 62,500 divided by 54 lakh 90,000. That's 0.1571. Then 5 lakh 77,500 divided by 54 lakh 90,000. That's 0.1052. Cost of equity is 18.69. Preference share capital is 10.09. Debenture is 7.99. Then you do the weights into cost. 0.7377 into 18.69. 0.7377 into 18.69. This is 13.79. 10.09 into 0.1571. 1.58. Let me make it as 1.59. Then 1052 into 7.99, which is 0.84. So if you just add them all, 13.79 plus 1.59 plus 0.84, 16.2. Yes.
So just a small doubt, sir.
Yeah.
So in the question, they have asked us to take the average while calculating the cost of debt and cost of preference.
Average.
Average, yeah, sir. In the last line, it asks us like to take average of the respective costs using white, like
Calculate the overall cost of debt
yield to maturity.
and preference
Overall,
share. Take the average of the respective cost using YTM and approximation method. Perfect.
yes.
So we have got the cost of preference share, cost of debt using approximate method. So we need to get the approximate is done. So I need to get the YTM values. Now for YTM values, we need to write down the cash flows year and cash flows. So we have here 0, then 1 to 10, and then 10. So year 0. So initial price will be minus 100.8. Okay. And then 1 to 10, every year it is going to be 7.5. 7.5 will be the cash flow. And then finally, redemption is at 110. We have got the approximate value 7.99, right? So let us do one thing. Let's take a present value factor at 8% and then do a PV of it. Okay, so present value factor 1. And can you give me the present value annuity factor, guys? Annuity factor for 1 to 10 and for the 10th year. Give me the present value annuity factor. 6.710. And what is the 10th thing? 0.4632. 50.33 and then 10 into 0.4632. 50.95. So if we just add them all, 50.33 plus 50.95 minus 100.8. So it is 0.48. 0.48 is a positive number. So let us do one thing. Take a present value factor at, we will need to reduce it, right? So let's take it at 9% and then give me the PV. Can you give me the total of present value at 9%, discounted at 9%, guys? Take a present value factor at 9%, take a PV and give me the total. Give me the present value, guys. Give the PV at 9%, please. Okay, this is what 5.995 and 0.463. 9%, is it same? No. Why do I think that this is incorrect? 1 divided by 1.08. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.4632. This one is different, right? 0.4224, yes. 4224, yeah. And the present value is what? Minus 9 point something. This is what? Minus 100.8. And this is 5.995 into 7.5, which is 44.9625. And then 110 into 0.4224. That's 46.46. So the total is what? 44.9625 plus 46.46. 91 minus 100.8. So this is minus 9.38. 9% present annuity factor is 6.4176. Is this 6.4176? 1 divided by 1.09. 1, 2, divided by 1.09. First year divided by 1.09. Second year, or just one thing. How much is it? 6.418. This is 6.418. Okay. And these numbers are going to change. So this is going to be 7.5 into 6.418, which is 48.135. And this is 110 into 0.4224. That's 46.464. And then when we add it, 48.135 plus 46.466 minus 100.8. 6.20. Right? 6.20. It's negative 6.20, right? So we have got two rates. At 8%, it is 0.48. At 9%, it is minus 6.2. Okay. So I'll talk of change in percentage and change in value. So when the percentage changed by 1%, when it increased from 8% to 9%, the value changed by minus 6.2 minus 0.48. So this is minus 6.68. But we wanted the value to be changing by just 0.48. We wanted it to reduce by 0.48 so that we know what is this x percentage when this is 0. So percentage change will be minus 0.48 into 1 divided by 6.68. So 0.48 into 1 divided by 6.68. This is what? 0.072. So IRR or the YTM is 8% plus 0.072, or this is 8.072. Okay. So here cost of debt will be 8.072. Okay. So these numbers are going to change. Whether the cost of equity will remain same, 18.69 itself. And the preference share, overall cost of debt as well as preference share, Lena. So you have to take the preference share, you have to calculate the cost of preference share also on a approximate basis. So can you do it on approximate basis? Approximate basis is what we have done already. Sorry, we have to do it using the YTM method. Can you do it using YTM method? Take the average of it. Sorry, I just took is 8.072, my bad. Average cost of debt will be 8.072 plus the approximate was 7.99. This whole thing divided by 2. So 8.072 plus 7.99 divided by 2, which is 8.031 or 8.03%. So this is 8.03. Can we do it same way for the preference share also, guys? The IRR? Yes, Shagufta?
Hello.
Yeah, Shagufta.
Yes, I have a doubt regarding floating rate.
Regarding?
Floating rate.
Uh-huh.
Floating rate will be reduced which one, face value or issuing price?
Issuing price.
Issuing price.
Yeah.
Oh,
Because
okay,
whatever amount you are getting from the issue of the shares or debentures,
yes, sir.
percentage of that we need to be paying, right?
Okay, sir.
Right.
Okay, sir. Thank you. Sir.
Okay. So now, just a quick task for you guys. Get the IRR for the preference share. Okay. Get the IRR for the preference share. Take the average of it. Put it over here and then do weights into cost weighted average. Can we do it? Can we do it, guys? Can we assume here face value is the issue price? No, because market price is given, Abhishek. Market price is given to us, so we can't be assuming that. Okay. So now just calculate the IRR for preference share. Take the average of it, substitute over here, okay, and then get the weighted average cost of capital. And then after that, you can just take a break, maybe, or rather, you can. I'm just giving you a bit longer break, maybe around 20 minutes. So in the 10 minutes, you just do that part, and then next 10 minutes, you can have a break and come back, and then we'll discuss these numbers, and then we'll go for the next question. Okay. So just get the IRR for preference share, take an average of IRR and the approximate value, substitute over here, get the weighted average cost, and then we'll discuss it after the break, guys. Okay. So let's take a break, guys. Okay. Welcome back, guys. So, what's the IRR for preference share? IRR for preference share is, because approximately preference share is 10.09. So, what's the IRR for preference share? Did we get anyone? Well, just to make the task easier, I can simply calculate that using Excel function. So, rate, you can use the rate function, where it is what? 10. N per is 10. PMT is, the installment is 12. Present value is 112.7. And then FV is 100 itself. Well, that's 9.94. Perfect. Yeah. So that's 9.94%. And then we have the average cost of preference share is going to be 9.94 plus cost of preference share is 10.09 divided by 2. So that's 9.94 plus 10.09 divided by 2, 10.015 or 10.02. So this is 10.02. And then when we take a weighted average, what's the weighted average number is? Weights multiplied by cost. Let's do this weights multiplied by cost number in calculation. What's the weighted average cost, guys? Weights is what? 0.7377 into 18.69. That's 13.78. Then we have 10.02 multiplied by 0.1571, which is 1.57, and then 0.1052 into 8.03, 0.84. Then, so that's 13.78 plus 1.57 plus 0.88, 16.23. Perfect. That's your weighted average cost of capital. Correct. Yes. Now, let us take up another question. Look at this question is. So we have the P Limited as a following capital structure. We have got share capital, preference shares, and debentures. Share capital currently trading at 100 is given to us. The company expected to pay a dividend of 5 per equity share next year. So this is D1, with dividends projected to grow every year at a rate of 5% per annum. The corporate tax rate is 35%. You have to calculate the weighted average cost of capital based on the current capital structure. Recalculate the WACC if the company raises an additional 5 lakh of debt by issuing 12% debentures. This change will result in an increase in expected equity dividend to rupees 7 per share, while the growth rate remains constant at 5%. A decrease in market price of equity shares to rupees 90 per share. So this is the second part. So first part we can calculate it normally. Weighted average cost of capital based on current capital structure. So based on current capital structure means just the book value weights essentially. Okay. And then we have to recompute the WACC by when you have this debt being raised and then new equity and everything comes up. Okay. So give it a try, guys. I'll just give you what 10 minutes because it's a 5 marker. So 10 minutes. Give it a try, guys, quickly. Okay. So what is cost of equity? Cost of equity, this is going to be 5 divided by 100 plus 0.05. K is 10. Perfect. Cost of preference share. Cost of preference share. There's no information about preference share issue price or anything. It will continue to be 12%. Cost of debt will be 10% into 1 minus 0.35. So cost of debt is 6.5%. Okay. Then weighted average cost of capital. We can get the weights. Weights is what? 0.25. And then it is 15 divided by 40, 0.375. So both the weights, 0.375, and we have the cost. Cost is what? 10%, 12%, and 6.5%. Then we get the weighted average cost. How much is the weighted average cost, guys? Weighted average cost 9.44. This is 2.5, and then 0.375 into 12. That's 4.5. 6.5 into 0.375, which is 2.4375. So when we add them all, we have 2.5 plus 4.5 plus 2.4375, which is 9.4375. That's the first part. Now, the second part of the question, recalculate the WACC if company raises an additional 5 lakh of debt by issuing 12% debentures. So we have the new cost of debt over here, which is 12% into 1 minus 0.35, which is making it after tax. So 12% into 0.65, 12 into 0.65, which is 7.8. New cost of debt is 7.8. Right, guys? This will result in increase in the expected equity dividend. So now we'll have a new cost of equity. So new cost of equity will be equity dividend of 7 upon market price will be 90 and growth rate will be 0.05. So now what's the new cost of equity? 7 divided by 90 plus 0.05. How much new? 12.78. 12.78% is the new cost of equity. Okay. So new KD is 7.8. K is 12.78. Now we can say again the weighted average cost of capital. So for that we have capital as equity share capital, debentures, 10%, 12%, and then preference share. So equity share capital amount is 10 lakh. Equity share capital amount is 10 lakh. Debentures are 15 lakh. Originally the debentures were 15 lakh. Preference shares are also 15 lakh, but now 12% debenture of 5 lakh will come in. That will give you new weights and then the cost and then weights into cost. So new weights are 10 lakh divided by 45 lakhs. 10 divided by 45, which is 0.22. 10 divided by 45, 0.2222. 15 divided by 45, which is 0.3333. 5 divided by 45, which is 0.1111. And again 15 divided by 45, which is 0.1111. 3333. Then the cost of equity is 12.78. Debt is the new debt is 7.8. And the original cost of debt was 6.5. Original cost of preference share was 12%. So then we do the weighted average cost. Is it 12.78%? Yes. Is it 12.78%? Everyone? Okay, done. New KO is what? 9 point something. Okay, new KE is 12.7. Okay. This is what? 9.87. Yeah. Fine. So this is your new overall cost of capital is 9.87. Okay, great. Let us take up one last question maybe. Okay, then we will look at another question. Just wait a moment. Okay, try out this question. This question number B over here. So we have this company which is already having a debt equity ratio of 3:7. The company is presently considering several alternative investment proposals costing less than 25 lakhs. The company will always raise the funds without disturbing its existing capital structure. It means the capital structure. Yes, Shagufta?
Hello.
Yeah,
Ji
Shagufta.
sir, I have a doubt in study material illustration number 18.
Study material illustration number 18.
Yes sir.
Bolo, what's the doubt?
सर न्यू प्रेफरेंस शेयर्स और न्यू डेप के बारे निकालने के कैलकुलेट करने के बारे में बोल रहे हैं.
Sure. Question number?
Illustration number 18.
Illustration 18. Okay. Yes, ma'am. Also, which one?
तो इसमें जो डिफरेंट ईयर्स दिया हुआ है और ईपीएस डिफरेंट टाइप का दिया हुआ है, ये मुझे समझ नहीं आ रहा कैलकुलेट कैसा करना है.
ये कैलकुलेट नहीं किया, ऑलरेडी दिया हुआ है ना बेटा क्वेश्चन में. इज ऑलरेडी गिवन इन द क्वेश्चन. So this is like you have to identify the trend in this. What is the change that you're seeing in EPS every year?
क्या बोले सर?
What is the change? कितना change हो रहा है EPS में? What is the percentage change in EPS? Every year, can you see there is a change of 10%?
Yes sir.
So that's your growth rate. वो growth rate identify करने के लिए सिर्फ वो pattern दिया है आपको और कुछ नहीं.
ओ अच्छा सर.
तो एक बार आपको growth rate आ गया, then you can calculate the cost of equity, right? Because an input in the cost of equity is a growth rate. One of the
Okay.
input growth rate, right? तो उसके लिए you have this trend given to us.
Okay sir. Okay sir. And I have more doubt in question number 4. Descriptive question number 4.
Illustration के descriptive question.
No sir, sorry, practical problem.
Practical problem question number 4.
Yes sir.
बोलो.
डेब्ट डिवाइडेड बाय इक्विटी मिक्स जो दिया हुआ है ना यहाँ पर 3:7.
हाँ.
ये मुझे समझ नहीं आ रहा.
So debt divided by equity mix, it means debt and equity का जो ratio होगा that will be 3:7. मतलब weightage of debt will be 30% and weightage of equity will be 70%. So when you're calculating weighted average,
Yes sir.
you have to take it in this ratio. Weightage of debt will be 0.3, weightage of equity will be 0.7.
Okay sir. Okay sir. You mean first of all I will calculate debt equity calculate debt, उसके बाद फिर I will calculate equity shares.
हाँ. Cost of equity weighted average के लिए निकालना है. Okay.
Cost of equity shares and cost of debt.
That you have to compute first, and then after that, when you're computing the overall cost of capital, the weighted average cost of capital.
Okay sir.
That is something which we have to, take the weightage as 0.3 and 0.7.
Okay sir. Okay sir. Thank you sir. Yes sir.
Okay, so let's come to this one, the question that we have taken up. So Vitarth Limited has currently debt equity ratio 3:7. We are not going to change that 3:7. So whatever money we are raising, we are going to raise it in this proportion 3:7. So we are facing a situation in which the cost of debt and cost of equity are going to change. So cost of debt and cost of equity are given 10, 12, 12, 13.5, 13, 15, 14, 16 with this ratio of 0.3, 0.7. Debt equity ratio of 3:7. So we have the weightage as 0.3, 0.7. Right. So for there are 4 different possible costs. So we have to calculate the cutoff for project 1 and 2. Cutoff rate means we are supposed to calculate the weighted average cost of capital. And if the project is expected to give an after-tax return of 13%, determine under what condition it would be acceptable. Okay, remember this KD is given and corporate tax rate is given. Of course, this KD, remember it is before tax. So to calculate the weighted average cost of capital, you will have to first make this after tax and then get the weighted average cost of capital. Okay, so try it out, guys. Okay, one more thing that if you want to calculate the cutoff rate, this is nothing but weighted average cost of capital. So give it a try, guys, quickly. Okay, guys. So first we need to get the post-tax KD, which is KD post-tax, which is after providing for deduction of deduction of the tax. So KD is going to be like 7% post-tax in first case. Then in the second case, it is going to be 12 into 0.7, which is 8.4%. And then 13 into 0.7, which is 9.1%. 14 into 0.7, which is 9.8%. Okay, that's your KD. Then we can get the KO figure easily. Now for KO, we know it is 3:7. So debt equity ratio is 3:7. So debt will be given a weightage of 0.3. So 7 into 0.3 plus 2.1. So that's like 2.1 plus 12 into 0.7, which is 8.4. So the overall cost of capital over here is 2.1 plus 8.4, which is what happened, man? 2.1 plus 8.4, which is 10.5. Then same way, the second is going to be 8.4 into 0.3, 2.52 plus 13.5 into 0.7, which is 9.45. So 2.52 plus 9.45, which is 11.97. 9.1 is the cost of debt into 0.3, which is 2.73 plus 15 into 0.7, 10.5. So 2.73 plus 10.5, which is 13.23. 9.8 into 9.8 into 0.3, which is 2.94 plus 16 into 0.7, 11.2. So 2.94 plus 11.2, which is 14.14. So the 15 lakh project, 15 lakh will be into this category, which is 13.23. Right? And for 26 lakh, it's going to be this one, which is 14.14. Right, guys? Everyone? Because if the fund requirement is 15 lakhs, it will fall into this third category, and there our minimum cost is 13.23. Right? And if it is 26 lakh, it goes into the last category, wherein we have a cost of 14.14. And if the project is expected to have an after-tax return of 13%, determine under what condition it would be acceptable. So if it is after-tax cost is 13%, of course the cost, the project size has to be less than 10 lakh, because if the project size is more than 10 lakh, then the cost is going to exceed, the return is going to be falling short of the cost. Okay. Fine. So this brings to an end for this topic of cost of capital. We've elaborately covered the core concepts along with approximately 4 questions we have covered in this session. If you have any queries or doubts, you can raise it right now, or else we'll just call it a day. Yes, Ashwini.
Hi, sir. Sir, I actually have a doubt from ratio analysis topic that we have done last time.
Go ahead.
So my doubt is regarding two ratios, which is ROE using DuPont and one more is the Q ratio.
Okay.
Sir, I don't get the logic for like I don't understand the concept of these two ratios. So and the main trouble is with the Q ratio.
Okay. That will require a bit of detailed working and all. So Ashwini, can you join in the next session so that I can take your doubt initially and then we'll go ahead with the next topic. Is that fine with you?
Yeah, sir, sure. You mean the next session, right?
Next session, which is the next Sunday. Yeah.
Yeah. Okay, sir, sure. I'll do that.
Yeah. Okay. So just remind me at the start of the session, okay?
Yeah, sir, sure.
I'll take that up, okay?
Okay, sir, thank you. And sir, sometimes, like while we are doing this cost of capital, during the second somewhere, they asked for the average of both debt and preference. So, sir, they have only asked for it for 6 marks, but that is very like lengthy answer, right? Like, how can we save time while solving that kind
See,
of
the paper
question?
will be very well balanced. So if one of the questions is going to take you a good amount of time, there will be another question which will be a very easy cakewalk for you. So there it will be, you'll be saving a lot of time over there in such questions. So that's going to go, they'll be offsetting each other.
Oh, okay, sir.
Okay.
Yes, sir. Okay, thank you, sir.
Fine. So let's just stop here for the day, guys. See you in the next class. Bye bye, guys. Take care. Good night. Yes, yes.